We are now turning to fixed income and specifically the Nedgroup Investments Global Strategic Bond Fund. I'm very pleased to welcome David Roberts from Palomar Fixed Income. David, how are you?
I'm very good, thank you. It's, as always, a pleasure to be on the call with you guys, and looking forward to the next few minutes.
Yes, and we always appreciate your time. Thank you so much. Dave, I guess before we jump into some of the details, just a quick question, please, on, like, in your view, what makes the fund special and different to the peers in the category?
Yeah, that's a very good question. We spend most of our time really looking at index rather than peers, and I think that in itself almost is a distinguishing characteristic. So we don't really care if other people are piling into risky assets or whatever they're doing. That's their business. We don't care about that. What we do is focus more on the index and our client expectations. So that's a characteristic. It also, I think, means that we tend to be maybe a little more conservative. So we focus on the large liquid entities, and we don't chase maybe the hidden corners of the market. Liquidity for us is all important, and I think we've seen volatility in the last little while that thankfully has also meant that people have given us some more money. So having that liquidity and being able to buy assets that are freely available, I think is also a defining characteristic. So we focus, we maybe think we care less about our peers, more about our clients perhaps, and we certainly focus more on the core of the market, investment grade and sovereign debt, and a little of high yield than others do.
I like what you mentioned there about you care about your clients more. I mean, that's definitely, I believe, the way to go. So, Dave, as you've started alluding to already, I guess if you look at Q1, it was a very tumultuous period. There's lots of macro uncertainty, a lot of geopolitical risk that's evident in markets. I mean, how did that play out, and how did the fund perform during that period, please?
So Q1 was really interesting. We had the first couple of months of the year where bond markets just continued in their merry way, prices rising, yields falling, corporate bonds doing well. We felt that the market was getting a bit too excited, and our total return was very high in February, and we used that as an opportunity really to, I guess, further de-risk the portfolio. So we took some corporate bond exposure out. We also we also took out government bond exposure, so we reduced the duration of the fund, and that meant that we marginally underperformed in February as the market continued to rise. Then along came Mr. Trump, and we're having the conflict in Iran, and bond markets performed quite poorly. Now, normally under those circumstances, we would struggle to keep up with the index. Again, we generally run an overweight position in corporate bonds, albeit high quality. However, we did lose money in March, but we very, very marginally sneaked ahead of the index, and that was really because of how we pre-positioned in February. So we found enough opportunity to play the volatility really in the market in March to offset our natural bias to higher, modestly higher risk assets. I'm sure for those who've studied our fund prospectus, they'll know that one of the things we have as in our mandate is we require a higher yield. So normally that means a higher risk than the index at all times. So being able to offset that natural position, exploiting the volatility, I think was very pleasing, albeit it did also accord in March with a period of negative total return.
Thanks, Dave. And I think quite a few times you've mentioned about the volatility experience and how you've found opportunities in the volatility. Can you kind of zoom in on that theme a little bit, please?
Yeah, well, we're seeing volatility in a couple of ways. I mean, one is very much within individual markets. So the general pattern that we've seen in the last 5-6 weeks has been toward higher yields. And it's very easy to say, well, yields start low and end up high. But in reality, if we were to look at any charts on single markets or indeed in cross markets, we see the pattern is not smooth. So we're seeing rallies, sell-offs, rallies, sell-offs, rallies, sell-offs. Now, because our portfolio strategy, our process is value-driven, that gives us really an opportunity. So when bonds sell off, we generally like to buy them, and when they rally, they become less attractive. And such has been the magnitude of the moves really across the G7 and indeed into emerging markets, that the perception is that we've flipped completely from a world where interest rates will be cut by central banks to ones where they'll be raised. And that, we use a specific example actually. So if we think of the UK, in February, the market thought that the Bank of England would cut rates twice this year. At points in March, that had moved from 2 cuts to 4 hikes. So a complete change in monetary policy. And that kind of thing gives us as bond investors opportunity in single markets and then also in cross markets, such as playing Germany versus Italy or that type of thing. So lots of opportunity created by that volatility. And honestly, the main source of volatility absolutely is the conflict in the Middle East, because if you move away from that, the pattern that we're seeing in economics is not really that different so far from what we expected at the start of the year.
I mean, David, I love how you definitely talk about the flexibility that the fund has in looking at different countries. I mean, Italy versus Germany, and you mentioned now about the UK and moves there. I definitely want to come back to that. But first, can we talk about what's happening in the French government bond market, please?
Yeah, so I think France is a really good idea of the interaction between politics and economics. So the French economy has been under pressure for a number of years. Simply put, they're spending a lot of money and the population is aging. So it's similar demographic to much that we see in, again, the G7. But the French political structure has been full of upheaval, and they managed to lose a couple of prime ministers in very quick succession. Which meant that President Macron then was struggling to form another government. The market didn't like that uncertainty. So the performance of French bonds relative to German ones was very, very poor. So normally these two assets moved in very much lockstep and they diverged. So that starts to give you an opportunity. And then just when we thought everything was nice and safe and France had found a more stable political regime, and then again along comes the war in the Middle East, and that really upsets everything. And it's only in that moment really you start to understand where the true risk or lower risk assets are. I hate to use the word risk-free, which people use frequently to talk about government bonds. There's always an element, certainly of mark-to-market risk. And what we saw latterly, again, has been because France has got this slight political issue and is more dependent on imported oil than other countries. Again, we saw that spread to Germany widen again, meaning French bonds effectively became cheaper. Now, we haven't really done too much there. All we've done is buy some short maturity French bonds, but relative to the US or to the UK, for example, we get a nice pickup for owning those, and very short maturity. Not quite yet got the confidence to move further into maturity profile, but so just we would say dipping our toe in the water, not quite plunging in head first yet, but dipping our toe in the water. And again, that's all the result of opportunity created by volatility.
Dave, and I guess coming back to the British economy and how it's been impacted with the Iran war and some of the factors you mentioned just now. Any comments on that, please?
Yeah, I mean, we always are, because we are based in London. The fund is Dublin in Ireland domiciled, but myself and Alex we work in London. So we're always very clear to point out that we are running a global portfolio. So, but the UK is about 5% of our benchmark. The problem with the UK at the moment is it's going through quite a turbulent political cycle. In all honesty, it's less so than perhaps the headlines are warranting. But we're moving away very much from a two-party system to a multi-party system. There are elections, equivalent really to the US midterms, but what we call them the local elections here, so local councils elected. And the ruling Labour Party is polling in about 4th place at the moment. So that creates a degree of political uncertainty. But when we look at the economics of the situation, UK economics is actually quite bond friendly. So debt to GDP is not as bad as elsewhere. The government's not spending as much money as other economies. And the finance minister has managed to stick to her golden rules. So it's created, we think, a little bit of an opportunity to consider the UK because there is a lot of political noise, which has meant that government bonds in the UK have underperformed. So just to put it into context, the index is about 4%. We are 6 or 7%. So we are overweight, but it's not like dominating the portfolio. It's just hopefully, again, one of those little opportunities that we can exploit for our clients, we hope.
Yes, we definitely hope. And David, I guess just turning to kind of your look on what the future could be like in markets. And I mean, we spoke a lot about volatility, about the opportunities that are emerging, some of the themes that are playing out. I mean, what are your thoughts on all of these, please?
Yeah, I mean, that's a really good question. When we think about, I mean, the UK is an example of this. What we're trying to do is look at beta, so the overall portfolio risk, and then alpha, the risks we can take without changing the overall direction. What we see in terms of outlook really is significant divergence continuing. You know, we mentioned France, we mentioned the UK. One other throwaway line from Europe, Italian government bonds. Again, Italy is perceived to import a huge amount of energy. Italian government bonds really have been bouncing around all over the place. So some of those, and this is still a member of the G7, so some of those create really strong opportunities to exploit that divergence without radically changing the overall direction of the portfolio. We'd say on micro, so we spend a lot of time looking at individual companies. We've not, because the market that we focus on tends to be higher quality, so we don't really play in the AI focus space. We don't really chase into the lower ends of the commodity spectrum. So we generally kept the corporate bond exposure quite similar at about 60% of the portfolio, but in short maturities. So if we see a renewed bout of volatility later in the year, then there should be a real opportunity for us to increase the weighting we have, the exposure we have to corporate bonds, hopefully to capture a potential rally. But we haven't really, despite all the headlines and the noise and sadly the loss of life we're seeing in the Middle East, we've not really seen that translate that into worries about an outright recession. If we move into that stage and corporate bonds suffer, then that will give us an opportunity. But at the moment, again, my summary of an outlook would be short term, it's absolutely still about the politics, and we have to respect that, both the global geopolitical landscape and then also individual country level.
Thanks, David. And I guess just wrapping up for today then, what are your, let's call it, some of the key takeaways that investors should be focusing on, and how does that underpin the current positioning of the fund?
So we expect volatility to continue. You know, I mean, I think anyone who claims they know what the president of the United States is going to say, never mind do, in the next 24 hours is, you know, we would suggest that no one, not even that man himself, really knows. And even if we did, it's sometimes quite difficult to understand the market reaction to comments or actions. So for us, we think it's about remaining true to our core values. So staying focused on core markets, looking to exploit opportunities when they occur, but by and large staying fairly close to the index, but using that, you mentioned it earlier on, our flexibility, our desire always to be an active manager to exploit those opportunities when they come along. And in all honesty, that could mean buying, it could mean selling from where we currently are. It all depends on how the market evolves in the short term in response to the current political tensions.
Thanks very much, David. That was a very punchy and fast-paced overview. Thank you very much. We really appreciate it, and wishing you the best of luck for the rest of the year.
Thank you. It's a pleasure as always, and look forward to speaking to you again in a couple of months.
Thank you.